All right, welcome everyone. Douglas here, MMT Macro Trader live stream. Welcome aboard for this live stream for Tuesday, November 29th, 2022 at 7 p.m. as we get things underway. Might even be later than that. I'm noticing my clock is not there we go. Now it's working. Anyway, if you're here, make sure you say hi, drop a line in the chat. Say hi. Make sure you hit the like button too, so we can get some viewership rolling and the YouTube algorithm to pick this stream up. And yeah, we have a lot to cover tonight. I have quite a few topics that I want to hit on. I've had some tweets go, viral for me at least. And yeah, what's going on, Michael? Glad you could make it. I've had some tweets go viral, at least for me, and I had some good feedback on those. So we will kind of dive into some more details on some of the thoughts behind some of those tweets, and just kind of think them through with a little bit more detail. Anyway, as people get rolling in for tonight and we get things underway, I'm going to start off with a discussion of where the markets are at. So, whoops, that's not what hold on one second. I think you guys can see the market screen. Hopefully that's what you're seeing. Let's see. Markets, I think, literally flat today. At least I saw on the ES they were literally at 0%. I think for the close today. Yesterday was quite the sell-off as we head into what is going to be a very it's going to turn out to be quite a monumental week, one way or another, for the long term trend of the market. I see the likes. I see the likes rolling in. Really appreciate it. Keep the likes coming. Definitely helps the YouTube algo. And if you are here, make sure you say hi as well. Get the chat rolling. If you have any questions, by all means, throw them out. We had a really good discussion to finish last week. That was a lot of fun. So fire the questions away. I'm definitely willing to change up whatever it is that I'm talking about to discuss any questions. Anyway, let's see. Today, what was I saying? Today, pretty tight day, all things considered. It looked like we might sell off, but we were able to hold on. And overall, just kind of another consolidation day based on kind of the takeoff that we had a couple days ago. Like I was just saying, though, tomorrow is going to be the day. We have Powell speaking at, I believe it's 2 p.m. I can pull up the economic calendar here. ADP employment will have come out, not the biggest. GDP growth rate for Q3, that'll be important. JOLTS will obviously be important. But the biggie is going to be when Powell speaks tomorrow at 1:30. Watch out, because that's when the market will certainly shake. So a lot of data coming out tomorrow, and then the Fed or Powell speech at 1:30. And one of the things you see as you head into big kind of economic news events is you will see options activity really explode. Usually, especially in kind of a scenario like we found ourselves in for the last year or so, kind of a relatively bearish scenario. You'll see a lot of puts get opened up out of kind of insurance, if you will. And I think that's really what we saw. Hey, welcome, Monique. Glad to have you here. Thanks for saying hi. Thanks for dropping a line. What ends up happening is you get a lot of hedging activity heading into big news events, oftentimes protected puts, kind of insurance style plays. And in those, what you'll see is a day or two before kind of a big news event, you'll see markets drop, which is, I think, what we got yesterday. It certainly seems to be indicative in the data itself, is part of the reason of the drop that we saw yesterday. And then these puts, these puts kind of reinforce the selling. They're almost a self-fulfilling prophecy. And then the news event happens, and then usually as the news event happens, whatever that news event happens to be, whether it's a data drop of something or another, a Fed announcement, what you end up seeing is volatility really spike as these puts either get closed, cashed in, whatever, and that's why oftentimes you see a massive move one way right after the data drop, and then you see the market whipsaw the other direction because that initial move is kind of forcing the hands of the market makers to re-hedge. Usually it's in the opposite direction of the market, so the market stabilizes, and then finally the people who opened up those puts, protected puts, insurance, whatever it was, then they finally make the decision, okay, do I want to keep this position on, or have I done whatever it is my objective was? And so that's why you oftentimes see, multiple moves take place, and usually why it takes, a 24-hour period or so for the direction after a major move to really sink in, unless it's a sufficient enough move to really sink into kind of whatever the next regime is going to be. In other words, the Thursday move after, was it the CPI data, I believe, in October. That's what it was. On the 13th of October, I think it was. Well, crap, I got the chart right here. Let's see. I think I'm thinking of the 13th of October. I mean, that's the sort of day where it just kind of kick-started an absolute rally, and then we just kind of continued. And then also just the other day on the 10th as well, we had a similar event where just the new trend was established. But that's kind of how to look at those things. I wrote up in my, if you're a Patreon member, to check it out, I put the daily dashboard up today and gave my commentary. I'm usually directionally agnostic on big news days. It's not kind of worth trying to predict that. I mean, if right now, I mean, I barely lean to the long side. I mean, I think ultimately things will resolve themselves to the upside, but there is a ton of volatility still priced into this market. So, I mean, it wouldn't surprise me if things falter one bit, but it's usually kind of the day and a half after the news event that the trend establishes itself. And that's really what I want to try and find out is in those events, try and find out, how is the market going to respond, and what does the data look like? If we get a sell-off, is there a high likelihood that sell-off is going to kind of be reinforced? And then you can make your decisions afterwards and say, okay, markets are dropping to a certain level, and and whatever level that might be, that's when we might want to look to reestablish a long position, or if things go higher, then what's the target to the upside? So that's my kind of quick overview of the markets. We are going to get to MMT stuff tonight. I can kind of list off the things that I want to hit on tonight. I want to talk about both kind of the quasi-viral tweets that I had this week, go over both those, go over kind of the fiscal flow, the long-term, what I call fiscal flow, and which is really just kind of the deficit over time, and the stock market. We'll talk about that. We'll talk about the tweet that I sent out today as well regarding rate hike policy and the implication of rate hike policy, easy for me to say. Those will be two of the big things I want to talk about. We'll talk about saving and kind of little sectoral balance discussion as well. And I think we can get into some deep discussion there. And then anything you guys bring up as well, we will certainly discuss. So don't hesitate to fire away a thought, a question. Obviously, am glad to kind of divert course and discuss whatever it is that wants to be discussed. If you haven't hit like yet, make sure you do that. Really does help out the YouTube algorithm. Even if you hate my guts, think I have it all backwards, all wrong, that I've got the levers put in the wrong direction, hit the downvote. I guess I think that still counts as engagement on the YouTube algorithm. I see the likes coming in. Appreciate that. Let's see a couple of things I'm watching right now too, just from kind of a longer term macro trend. I've got those up on the screen right now. Going to be the U.S. dollar and oil. Let's go U.S. dollar first. Let me kind of discuss this. And the big implication here with the U.S. dollar is I see the U.S. dollar not only is just kind of the price of the dollar versus the basket of currencies that it's against, but I also see the U.S. dollar and the general trend of the U.S. dollar is a bit of a measurement for the global financial health, right? The reason for this is, in my kind of MMT heterodox mind, as credit expands in the global financial system. So this is specifically thinking the Eurodollar system, right? I'm not thinking domestically in the U.S. banking system. I'm thinking the Eurodollar system. this puts downward pressure on the US dollar. It's effectively a synthetic short. Technically, you're creating more money when you do this. And so generally when the dollar pushes lower, you're going to see economic expansion. When you see these instances, these cycles, these 60-year-month long cycles of the dollar just shooting up very quickly, which we've seen quite a few times in the not too distant past, really starting all the way back in 2008, heading into the great financial crisis again in 2010, and then again in 2014 into 2015, and then more recently, obviously over the last year and a half. These sudden spikes higher are in my mind, indicative of the global financial sector being effectively short of dollars and trying to go ahead and get dollars to cover whatever sort of debts that they have to pay, and so you see this cycle that ebbs and flows, the dollar pushing down or pushing up, pushing down, and then pushing back up. And to me, that is really just kind of the breathing, if you will, of the global financial sector. And so with the dollar really giving way now for quite a few weeks, I think we topped back on September 27th, 28th, with the dollar starting to push back and continuing to kind of consolidate here. After the initial drop and kind of continue its consolidation. To me, that's a relatively good sign that we might be kicking up the next kind of credit impulse cycle, the expansion of private debt cycle again. When I say good, what I really just mean is relatively bullish for markets. And that the bank flow cycle might start kicking up again. So if the dollar suddenly really reverses course and we see a quick rally back up to prior highs that we saw in September, then that gets really worrisome, and I think spells a slightly more bearish outcome going forward. But so far, I'd say so good regarding the dollar, especially kind of that we've stayed pretty contained in the consolidation after the drop a couple weeks ago. The other thing, hey, what's up, Robert? Let's see. It seems like the USD has been following oil price closely, maybe because of the large U.S. oil exports. Yeah, maybe there might be a little bit of disassociation there due to the new oil dynamics. That could turn out to be the case. Good observation. Oil, though. Speaking of oil, it is the next thing that is really on my radar here. Usually, oil suddenly taking a dive would be a bit of a concern because, again, thinking kind of global macro here, if oil is pushing lower, that likely means that especially when oil drops off very quickly, right? Let's not take the post-COVID spill into consideration. Obviously, that had its own dynamics at play. But let's take the 2018 drop into the end of 2018, or that 2014 drop into early 2015. To me, that's usually an indication that there are central banks that have oil reserves, that they are local domestic banks are calling them up saying, hey, I'm short on dollars, right? I've got these dollars-denominated debt that I have in the Eurodollar market. I need to pay this off. Can you help me get some dollars or dollar swaps? And so what will oftentimes happen is you'll see oil completely give way as there needs to be dollar reserves getting rounded up by the central bank. And that is usually what I would interpret the oil drop to be. However, right now, I think a likely explanation is the fact that it looks like there's kind of a quid pro quo between Biden and MBS over in Saudi regarding the Khashoggi incident, and it looks like the Saudis are maybe willing to bring down the price of oil. Obviously, they have kind of the ability to do just that. And the impact of that is oil certainly is one of the larger drivers when it comes to kind of overall inflation in the inflation cycle. So if oil continues to push lower, that's only going to help mitigate the impact of inflation. Obviously, there are many inputs into inflation, but relative to kind of the new dollars coming in from the fiscal side, the cheaper oil is, the kind of more impactful than every new dollar is coming in relative to kind of the overall private sector. So that's a third thing that is kind of on my dashboard to be paying attention to. as we kick the week off. Let's see, one final word on the market, and then we'll kind of get into the MMT discussion. And that is, not only do we have what's going on tomorrow, which is going to be really, in my opinion, the big decider for the direction of this market as we head into the end of the year. But we also have on Thursday ISM manufacturing, and then Friday we have jobs data. So a lot of data ahead of us, and that's certainly going to make markets go a little wild for the next few days here. And then I think once the dust settles, we will see. We'll see what direction the market ultimately lands in. So. Yeah, that's where we're at, I guess. Let's see. Let's do this. Let's talk deficits. How about we do that? And if you have any questions, send them in. If you have any comments, send them in. If you have any disagreements, send them in. By all means, we can get a discussion going about anything you want. I'm trying to think this through, Robert, one more time. It seems the USDA has been following oil pretty closely, maybe because if we're net exporting oil, of course we're getting dollars back, right? Because they'd be buying oil in dollars. So I don't know if importing financial assets as dollars due to exporting oil would necessarily push the dollar lower. Yeah, I'll think that through. It's been kind of in the back of my mind, and I wanted to think that through a little more before we moved on. So anyway, let's move on. Good observation, and let's do this. I'm actually, what I'm going to do, give me 1 second. I want to test this out. Yeah. So I do have a new kind of just chatting window. It works. I want to pull up my Twitter, but I'm always a little concerned as to actually what's going to come up on my homepage, just in case. So while I do that, let me scroll down here. Let's see. First tweet that we can go into, and we'll kind of go into the some of the thinking behind this. Is this one right here, that it's almost as though public deficit equals private sector savings. Maybe that MMT stuff was onto something. Had a lot of good discussion regarding this tweet as well. What I want to do is pull up. I actually brought this data all the way back. Give me a second, because I realized I have the wrong chart pulled up here. Here we go. No, maybe I don't. I thought I had this data pulled all the way back to, oh, well, you know what, maybe I'll tweet it out, but I was able to I'm going to go ahead and switch on over now to my data dashboard. I was able to get this data pulled all the way back to the 1940s, and this is the, let's see, yeah, it's pulled up now. Anyway, this is what I posted on Twitter. This is the S&P 500 overlaid on top of the national debt, which is adjusted for inflation. And like I said, I'll tweet out if anyone wants it. Maybe just contact me. I have this data going all the way back to the 1940s. Correlation obviously fits all the way back. It actually fits even more tightly. We'll talk about that in just a second as to why, going all the way back to the 1940s. But yeah, I did post this, had some really good discussion on it, obviously some disagreement, but I kind of want to talk, and it might be a little spurious claim here to say correlations 1-to-1, and we'll talk a little bit about the implication of correlations and whatnot in just a second. But I mean, I do think there's a reason for this, and we can kind of talk about that as we go along. Let's see. Monique, hey Douglas, I've been trying to understand the value of gold from an MMT point of view. Since gold cannot be used to pay taxes, does it also have no value? Yeah, so I'm not a gold bug, and I don't. I mean, it obviously has industrial value and it has value to someone. So yeah, we're talking gold. Let me pull the chat real quick. We're talking gold real quick, then we'll jump back to that chart. In terms of gold itself, obviously it has the value that any holder of it wants to apply to it for their own personal sake. But I wouldn't say gold is money. Certainly, and throughout history, nations will use gold for reserves to kind of show that they have at least something of exchange. That if you're going to, so I mean, a way to maybe look at it is from a small country, if they want to start exporting their goods or importing goods of another nation, and they want to use their own currency for that, what they can do is back their currency by gold to try and entice people to use their currency for exchange. And then obviously, if you can exchange your currency for the gold reserves the central bank would have, then you might be a little bit more willing to trade with that country. I mean, I think that's just a terrible idea from a fiscal policy standpoint. The goal of a government or a central bank kind of working with the government should be to facilitate full employment, to facilitate the goals of the state, to just better the economy as a whole, right? To work on infrastructure, to work on any military needs, all of those things, I think, is what the government is trying to attempt to do. And getting on a gold standard is really just a hindrance to that entire process. It doesn't need to be done. If you have an economy that makes goods and services and other resources that the rest of the world wants, you're going to get your economy off the ground, and eventually, your currency will be desired for trade. So, in that sense, I don't think let's put it this way, for a monetary system, I don't think there's much value for gold. For better or worse, though, gold is obviously highly valued in monetary systems, and so you do see the gold cycle follow the overall business cycle. That's certainly something that happens. But suffice to say, if I was king, gold wouldn't be anything that I'd be really looking to use for monetary purposes. So yeah, I hope that answers your question, and feel free to follow up if you have any other thoughts. Switching back over to the data dashboard here, and again, this is what I tweeted out going back to the 1970s. Correlation between the S&P and the national debt. And again, as I was just mentioning, I could see this being a bit spurious, and I agree that obviously the correlation is not one for one, and correlation doesn't necessarily prove causation, and down the line. But above all else, I think what I'm trying to prove, or what I was trying to prove with this tweet, is that in order to save, there needs to be savings, and only the government can supply that savings in net. Right now, obviously, there's saving and savings. There's the decision I make to spend or not spend, and the cost at which I'm going to spend it, and then it's just net saving for the private sector, and that is the side of things that I'm talking about here with regard to this correlation. And so I think what I'm trying to establish with this is twofold. One, that the deficit, essentially the market cap of the stock market, is going to track the deficit if, and this is the big if there's a condition to funnel money into the stock market. And in the U.S., certainly there is a condition. And if we're trying to save, what is it that we're trying to do when we have that savings, right? We're trying to dodge that savings from either being inflated away or from being taxed away. And so if you can have some of your income immediately diverted out of the tax siphon, and you're going to do that, right? It makes absolute sense, because that's one way that your wealth can be destroyed. And in the U.S., there's 401ks and other deferred tax ways to save, and most of those find their way into equity markets. And then the other one is also going to be inflation, and obviously just because of the dynamics that MMT understands, that as inflation pushes higher, so too is likely going to be the market, just because of those dynamics. So the market's a great place to get away from both taxes and the implication of inflation. And so you're going to see a general correlation between markets and the national debt, because the national debt is the private sector savings. So I do think there's a correlation here that makes a lot of sense. Obviously, if you're an astute observer, there was a time period where they really got uncorrelated. We can talk about that in just a second. Let me read this comment real quick. I'm going to switch over to the chat window here. Jesus, gold is a good tool to rob. I can't. You guys don't know this, but I have a teleprompter in front of me. I've been working on it. It has a little Raspberry Pi monitor underneath it that shows me a handful of things, but I'm realizing my eyes are getting older than I thought, and so I have the chat in front of me so I can keep looking at you, but I'll need to make it bigger for next time, so bear with me. Gold is a good tool to rob people that don't know any better. Scream gold going to 10K because all money printing hyperinflation and people hand you their hard-earned dollars. Yeah. Is a bit true. I've told the story in the past. I used to be a gold bug very early on, and I certainly bought into post-Great Financial Crisis, immediately kind of the Peter Schiff line. And I've told the story in the past, so I won't go over it unless someone really wants to hear it again. But that's where I kind of started my macroeconomic journey, at least, and very quickly realized that none of the way that kind of the Austrian world modeled the economy was ever predictive of anything. I mean, they would, yeah. I've beaten this horse before, but I could never find data that was like, oh yeah, like this is a causal factor for this event occurring. It was always something. There was always some reason why it wasn't happening that always seemed quite spurious. Speaking of spurious charts, Bob Knight, are you still bullish on the S&P? It looks like we need a further move down 100 points more and then up. I wouldn't even say that I'm bullish, Bob Knight. I hope are you referencing the basketball coach there, a legend? I'm in the Big Ten country as a fellow Big Tenner. If you're not, and you have no clue what I'm talking about, he was a basketball coach years ago in the Big Ten. I would say I'm bullish. I am still long from a couple weeks now, but I would say that the reason I'm long is the signals that I've gotten is for a counter trend bounce. And I don't know if you were here to kick things off, but I talked markets a little bit for a few minutes. But I am a bit concerned about tomorrow and then through the rest of the week. So I could easily see a bit of a spill. And you mentioned 100 points down. I think there is some support showing up right around 3,900 that I think would make a lot of sense for us to hit. I know we're a little more than a little less than 100 points above that, but yeah, I could see that playing out tomorrow. So again, I'm not bullish in the sense that my models are bullish. I'm just long because the short-term swing here is long. Monique, I agree that a deflationary commodity like gold would not be appropriate to be used as money. Just wondering how it has been keeping its value. Okay, I'm gonna linger on this because I agree. I agree because I think the answer that would most likely be given for how's gold kept its value would be because people don't know better, which is just an answer that I absolutely hate. I'm not saying people can't do things because they're wrong. I'm just saying that there usually should be some sort of structural issue that if price tracks some sort of commodity that goes against kind of what it is I would believe, that I would want some better explanation. I think really the only explanation I can really give regarding gold continuing to hold its value, that's not because it has what I'll call kind of sentimental value or industrial value, really is because it still is a tool used for central banks throughout the world. It still is a reserve tool for central banks. And I mean, even the Fed has tons of gold on the balance sheet. So I would imagine that is why it continues to keep its value within the marketplace. Yeah. Good question though, because I've thought the same thing. So really good question, and I don't know if that's the best answer, but I think that's the most appropriate answer, at least that I can come to right now. Let's see. Let's move forward here. And go back to the chart here. So a couple things. There's two things on this chart that I want to look at. One of the things actually Warren Mosler tweeted me out to do is to look at what happened prior to the 1980s during the inflationary period. And I've heard him in many podcasts. If you haven't listened to some of the podcasts he's done in the last year or so, and you're really interested in kind of the MMT macroeconomic case, he's done some absolute great interviews as of late over the last year or so, especially with Patricia. And if you're in the chat, help me out. And one of the MMT podcast, just some absolutely great interviews, especially kind of, and he gets into some great theories just regarding MMT as a whole. And one of his points about what happened back in the 1970s is that inflation was so high that even though we were still having, technically deficits that divided out by inflation, the real deficits were quite low, and that's what really was leading to the recessions. And this chart is the total national debt over time, adjusted for inflation by the CPI. Patricia and Christian, yeah. Thank you. Check them out too. I mean, is it called the MMT podcast? I think it is. Check them out if you haven't seen them. It's a well-paced, good discussion sort of podcast, and it's on YouTube as well. And it's I rate podcasts by how fast I need to listen to them at 2x speed, 1.5x speed, that sort of thing. And in other words, if it's a discussion like this, it's just rambling on. It's a 2x speeder until I get to the good stuff. Their podcast is definitely a 1.25 to a 1.5 listen speed for me. So it's a good one where you really want to listen to it slow and take it all in. Anyway, one of the points he's made is really was the inflation that was adjusting kind of the real dollar lower that's heading into the economy during the 1970s, and that continued to really suppress the economy, and it absolutely shows up in the data, and I think that explains very well why the stock market was having a lot of issues. I guess I can do this. Let's do this. Let's zoom on in. The next question is then, kind of what happened, let's just say, starting in the 1980s. Obviously, the stock market really started to take off relative to the national debt, and it took a while for the national debt to take off. And it's always important to point out that starting in the 1980s, that's when bank deregulation really took off. And in my mind, at least in terms of kind of the post-World War II economy, there's kind of four segments of it. There's pre-1980. There's the pre-1980 world, so pre-1980 to the end of World War II. There's post-1980, and the reason is really because of bank deregulation. I think that's and one of these days I'll do some more research to really nail all this down. But I do know that's when a lot of the bank deregulation occurred, that allowed for kind of the financialization of the economy to take place. Then there is from the 1980s to the Great Financial Crisis. So we have pre-1980s, 1980s, up to the Great Financial Crisis, which would be kind of the next big change. And then now we are in for kind of a final or kind of a new regime in the post-COVID regime. After the Great Financial Crisis, the big change was a complete overhaul of how the Federal Reserve is going to deal with banks. The idea obviously was QE and shove them full of reserves, which started its own regime. And you can see correlations really start to change, particularly after the way in which the Fed started to use reserves and QE to accomplish their objectives. And then now we're kind of in this new stage post-COVID, where I mean, obviously we haven't. I don't want to call it kind of the MMT era, but we're not quite there yet. But at the very least, for the first time in history, beyond the $600 check we got from George W. Bush in 2003 or whatever it was, the $300 check that we got for the first time ever, at least in kind of the modern economy that I'm aware of, we really had real direct stimulus, and that created a bit of a new regime in terms of how central banks and policymakers deal with things. But the change into this kind of fourth regime is not quite as impactful and different from the post-great financial regime. But that's kind of the landscape in terms of where I think things would play out, or kind of how I would see things play out. But going back to the chart in front of us, I see a chat just came in. Maybe it didn't. Anyway, going back to the chart in front of us, one of the things that happened post 1980 was a massive jump up here in private debt. So not only do we have deficits absolutely explode post 1980, but we also had the private debt bubble starting to really kick off in the 1980s again because of bank deregulation. And then we get to kind of the time period that I want to zoom in on, where we finally start to get correlation and breakdown between the national debt and the stock market as a whole. And this really has to do with the fact that this is when the private debt bubble really started to take off, and obviously the dot-com bubble blowing up during the Clinton surplus, creating what would ultimately become the greatest financial crisis of any of our lives, most certainly. And that's why you saw the disassociation of the S&P and the debt, because the savings that wasn't there from the deficit was being made up for by debt spending, private debt spending. Then we had the great financial crisis, and then we were back on with a pretty good correlation between deficits and the S&P. And again, the big reason that this happens is because savings is really going to take the path of least resistance to the least amount of damage to taxes and inflation, and obviously in the U.S.'s case, that's going to be finding its way in stocks. Which also, I mean, another good point too is I think this also creates kind of a reinforcing cycle as well for the rest of the world to also want to invest in stocks. A couple of reasons. One, they're just going to continue to go up because the U.S. spends, and so the rest of the world is going to be incentivized to kind of follow that trend. And the next thing too is U.S. stocks are dollar-denominated assets, so just another way to get your hands on dollars if you're going to suddenly need them. So it makes sense that I think there's central banks that have bought, Apple or the S&P and that sort of thing. So, yeah, I mean, that to me that makes a lot of sense. What's going on, Adam? Welcome aboard. And the chat window, I'm noticing the chat window that I have is not tracking what's actually going on in chat. So give me a second. Let's see. Can it? Okay, this is really weird. So I have two chat windows up. I'm gonna pop open the chat here. One, welcome, Adam. Glad to have you here. And number two, this is really funny. The chat window that I have is not showing me the question that you dropped, Bob Knight. Can revolution be starting in China? And the end of the CCP mass riots in China now. S&P collapse. I don't know about the S&P collapse, but it is funny to me that didn't show up in my chat window, but yet staying on the YouTube chat. So I don't know. Maybe there's a conspiracy theory underneath all of this that the Chinese have access to my live stream and are cutting out. Yeah, man, the stuff happening over in China is quite wild and very worrisome from obviously a global perspective, and certainly it seems as though something might be something. It's really weird that we can't see that question. Yeah, man. Okay, for the live streams, my goal is to start these. My goal is to usually do these on Tuesday. I really like Tuesday for the live streams. One of the reasons is still a lot of the week is in front of us, so it's kind of fun to make predictions. And then and it's not Monday. So the only issue is my daughter has dance on Tuesday nights. I do like to, I'm a sucker for that stuff. I do like to take her to that. So sometimes Tuesdays can be a little difficult if that's her night for dance. But I like landing on Tuesday so far. I'm seeing my numbers tick up, and I think this might be the day that I finally just lock in as the day that we do the live stream. Going back to your question though, Bob Knight, can revolution be starting in China at the end? Yeah, there's some wild stuff, really wild stuff happening. The COVID camps that they're building, very concerning for a country that effectively doesn't have COVID. I mean, if they're anticipating COVID, I don't know. But I'm sure, let me see. Let me see if I can pull that up on Twitter. Yeah, I don't have. I'm sure you've seen the video on YouTube and Twitter rolling around about the addition of the massive COVID camps. And then this is a big risk for me, but I'm going to open up. Well, actually, I could do this. I bookmark a lot of stuff in Twitter. I'm going to switch over to that screen. I bookmark a lot of stuff in Twitter. Some of it is kind of meme jokes for me and my buddies. And I'm just going to show you my bookmarks. And I'm like, I don't know, man. I might get myself in trouble, but I can just jump to the tweet itself. But I saw this as well come in today. And it's apparently, according to an English guy who translated all this, apparently the police are checking phones in China to make sure there's no illegal apps on the phones, and so you get these COVID camps that are being built up, checking on phones. I don't know. Seems like something's brewing. I mean, it makes you wonder if they're kind of prepping for invasion of Taiwan here, or something like that. Big move here, because maybe that explains the camps. They're going to have to throw people in the camps. I mean, I don't know. Obviously, I'm speculating, and it sounds very much like a bit of a conspiracy theory, but it doesn't seem too far off the smell test for something that could be underway. So it does make me wonder, though. I mean, you bring up a good point. Could that collapse the S&P? I mean, the Russian invasion of Ukraine obviously really took the market out, and it hasn't recovered since. So yeah, I mean, it does seem like geopolitical issues can certainly run amok, and yeah, I mean, that could be maybe the next leg to kind of shake markets. I do think, in my opinion, I mean, take me for an armchair analyst here on geopolitical issues, but I don't. I mean, I think China would be in the same spot Russia is a year from now. The way that Russia is 1 year, almost 1 year after the invasion, 10 months after the invasion or whatever, where they're just finding themselves in a bad spot. I mean, the one thing China has going forward is the world is heavily reliant on their exports. I know the world is heavily reliant on Russian oil, but I mean, there are a lot of exports coming out of China. So, but the little I've researched, I don't know if it really is in their best interest, but it is a bit concerning to see steps starting to get ramped up that at the very least seem to kind of correlate with what you'd be doing if you needed to really suppress any dissent. So yeah, we'll give it that much. Yeah, good questions. Keep them coming in. Happy to change course and discuss anything that comes up. Let's see. We've kind of hit on the main topics regarding national debt and the S&P. So let's jump to, what was my other tweet? I think I had going on there. Let me pull it up. Oh yeah. I can jump right to. Let me actually do this. Give me 1 second here. Let's see. Yeah, man. Glad you're enjoying it, Bob Knight. And the Elliott Wave Master. Yes. Yeah. If you saw the last live stream, one of the follow-up tweets, someone kind of came at me for Elliott Wave, and I talked a little bit in the last live stream, maybe it was 2 live streams ago, about why I actually kind of like Elliott Wave, and I think there might be some scientific, maybe pseudoscientific reason why Elliott is still kind of worth it. Let's see, or at least why there's some explanation, scientific explanation as to why Elliott Wave actually works. All right, let me jump back to a different screen here. Okay, so the other tweet I sent out earlier today, we can kind of go through this and discuss the overall idea here, is that rate hikes are insidious. They Nice, man. Well, yeah, I'm. Okay. Let me jump on Elliott Wave for a second, then I'll go back to the tweet in front of me. Elliott Wave. Really, I kind of do a cycle between, definitely allow my kind of Elliott analysis to inform my macro analysis, but usually it's going to be macro analysis informing my Elliott analysis. And what I do is, I kind of have a macro outlook and I say, hey, based on my macro outlook, what is a likely outcome for the market, right? And still within the rules of Elliott, and I follow, I think, what is just a classic Elliott rule set. Within the rules of Elliott, given my macro analysis and the conclusions that I've taken from a macro analysis, how do I think the market's going to play out? What kind of wave structure do I think is going to play out? And it's I think like an analogy that I've heard before that's really good is it's a battle plan. It's the playbook. Obviously, I don't know what when I go out there onto the football field, American football field with the World Cup going on, not to be confused. When I go out there, the football field, I might have my spread offense or whatever, my run pass option offense or something like that. And I don't know, I can scout the other team, but I don't know what defense they're going to bring. I don't know how they're ultimately going to defend me, but I've got my playbook, I've got my options. And when things go awry and they don't go the way that I think they do, I can obviously pivot and figure things out. But if it is what I expect and things are playing out the way that I expect, then I think Elliott becomes a very helpful tool. So it's kind of a way for me to kind of check my thought process and then and then see if the market plays out the way that I think. And if it does, then good. And I can kind of know what the next step is after there. And then if it doesn't, I can reassess as to why things kind of went awry. So yeah. I mean, I think it's the right way to use Elliott. And then I think also Elliott Wave is a really good language to speak. It's a very simple language to speak. By that I mean you can look at an Elliott chart and understand exactly what someone's communicating based on the way that they annotate the chart and the way they label the waves. And so I get a lot of non-English English as a first language speaker people who will engage with me because it's just they can see the chart and they know what I'm saying and what I'm trying to communicate. And I think that's a helpful aspect to Elliott too. And with just a handful of tools, you can really kind of communicate. Hey, I think this is an impulsive wave. Hey, I think this is a corrective wave, and that has broader meaning as a whole. So let's go back to Twitter here. And again, I posted this today. Rate hikes are insidious. They drive prices higher for those who don't have money while supplying risk-free income. For those who do, only MMT understands this. Debate all you want the merits of the stimulus checks, but at least they increase wealth for the bottom 50%, not the top 1%. I'm going to hang out here for a while on this topic because really, this is a great insight on in terms of MMT has a great insight. My insight is good, but MMT has a great insight on interest rates, on the impact that they have on the economy and the impact that they have on wealth distribution and how they work in wealth or push the wealth distribution as a whole. I'm going to switch to, let me actually switch to this chart right here, which is, I posted two charts. This was the first one. This was the second one. We can play around with those in just a second. I've gone over in prior videos. You don't have to look too far back to find a deeper explanation of why interest rates push prices higher. But above all else, from kind of an MMT perspective, we would see this as a inflationary push because primarily the term structure of prices gets pushed higher, and then the future cost of doing business gets pushed higher. Right, the higher the rates, the more money it's going to cost to borrow, or the more expensive it's going to cost to borrow money in the future, and therefore prices get pushed higher from that. And then the other reason is the income channel. As rates go higher, the government pays more on its bonds, and then that becomes income for the private sector as well. And so both of those things generally push inflation up. And I've found just tons of correlations chart correlations that continue to kind of confirm this. One is up in front of you. This is monetary interest paid on government let me zoom this in to when it actually starts for both series. Monetary interest paid, that's the blue line on the government debt, and the red line is CPI, and you can see a pretty strong correlation there. Now, a quick word on correlation. Again, I'm not trying to necessarily claim causation here per se, but Over and over and over again, you continue to see these correlations where you expect to see them based on the MMT framework, and eventually it becomes too coincidental to see this sort of stuff. So, to me, these track because Mosler's ideas here on what rates are actually doing they're just correct, and they're correct logically no matter what, but it does seem to show up in the data as well. Monique, I'll get to your question in just a second. I haven't overlooked it yet. So this is kind of the first impact of this. You also see this in velocity of money and rates tracking. That shows up. I think that kind of proves the term structure prices idea as kind of a lever for inflation. And so going to kind of the insidious part, right? So if rates push prices higher, the only people that are benefiting from those higher rates are going to be the wealthy, and the only people that higher prices as a whole kind of doesn't impact would be the wealthy to begin with. And look, I don't. It's not that I have it out against the wealthy. I don't care. Actually, when we look at the next chart, I'm in the demographic that got the most screwed over the last year and a half. But it's not that I care about the wealthy not getting there or whatever. I don't. It's not my thing to bemoan wealthy people. What is my thing, though, is we shouldn't be punishing the bottom 50% of wealth holders, right? That is the insidious part about all this, is that the rates are keeping prices high unnecessarily. And given obviously the impact that we had post-COVID and then post-invasion from just inflation as a whole from the supply side shock of things, those prices are being kept high because of Fed policies. And that's the insidious part, is that the prices are being kept high, and that even though there is an income channel that is happening from that income channel is only helping you if you have large treasury holdings to begin with, right? So granted, that's going to increase net savings, but that's not like it's not trickling down, that's for sure. So that is, and that again kind of adds to this insidiousness, because what it's going to do is all things being considered, if there were no transfer payments to wealthy people in a rate hike cycle, you could make the argument that might start to put the crunch on business activity, right? It would, as a whole, you could maybe see that taking place. But the fact that those transfers are happening only adds stability to the financial sector, right? Which only allows the kind of inflationary push to perpetuate. So it just adds to, really adds to the absolute pain of the situation. Let me jump to the chat menu here real quick. Do you think that the drop in oil price would have a higher propensity than the increased fiscal flows due to interest payments trying to play the next CPI event? So I think your question is, what is more impactful to inflation, the fiscal flows or oil? It's going to be oil right now, without a doubt. And the other thing too, CPI is just the measurement of prior prices. Specifically, inflation is such a multifaceted, well, I don't call it a diamond, but it's such a multifaceted kind of measurement, and in terms of what it actually means, what it actually is. I actually get myself in a lot of trouble here and tell you that I actually think inflation in terms of a currency that is being devalued is actually a good thing. Maybe I'll get into that later if if you want me to. I have critics already, and I'll tell you what, if I explain that and how that works out, they will lose their shit. But maybe I will. So maybe we can get into that in just a second. Let me mark that down as something that I want to get back to. But in terms of what's going to make the most impact for CPI, I would imagine it would be oil, right? So that's not to say that fiscal spending can't cause what would be measured by CPI inflation, but right now I'd probably say oil. Let's see, Peter Elliott, welcome. Let's see. Beyond the direct impact to inflation, does the flow of bank credit respond negatively to interest rate hikes, as the neoclassical theory suggests? By bank debt, I mean bank lending. Okay, I've done some correlation analysis on this. I don't necessarily think so. That's a good question. I will give me a couple weeks, Peter, and I can put together some research on this that would be worth discussing. I mean, as it turns out, the Fed rate hike cycle and the business cycle just over the last we'll call it 20 years, 25 years, have just tracked each other just because they have. I mean, I think they've been relatively independent. But, the Fed sees things, markers that it doesn't really understand, and then makes decisions based on those that just turn out to be the markers that happen anyway at the end of the business cycle. I don't know if it necessarily does, but here's my theory of how it would, just for a second to hang out onto this. And again, I've talked this through with some people that really understand this, the real mechanics, the deep mechanics of MMT maybe better than I do. And I'm still willing to be up to persuasion one way or another. But here's how I do think you could see a world where rates actually do end up getting in front of or causing the end of the business cycle, right? So a couple things we know, right? Rates push prices higher into the future. Higher rates also supply the necessary income into the future, right? So in other words, they not only are they going to push inflation high, but they're also going to provide the income for that inflation to not kind of be detrimental to the economic cycle. However, as I was just explaining regarding higher interest rates and kind of the insidious aspect of them, they're only supplying those net assets to the wealthiest people, right? And and by the wealthiest people, I don't necessarily. Those assets are going to come to people who own treasuries, which usually, you're obviously, when you get an interest payment on the treasury, unless you're retired, you're not looking for that to become income to spend, right? That's just going to continue to accumulate in your savings to begin with. So with regards to the higher interest payment, so on net, in terms of the net private sector saving, that's going to increase. So that's going to give for the entire macroeconomy a cushion. But what I do think can happen, and the channel on which I do think you can get, but I'm trying to make sure I phrase this all correctly, because I'm sure people will call me out if I am not phrasing this perfectly. But I think what you can get is, when I'm now thinking kind of the Steve Keen, Minsky instability hypothesis, financial instability hypothesis. I think what Steve Keen says, or kind of the conclusion there, is that as that private debt load, or just the credit cycle pushes higher, right, as the private debt expansion happens, it's the wages share of GDP that continues to get compressed for the workers, right? And so the workers get relatively poorer and poorer and poorer, get a lower and lower share of that, and then their demand starts to compress, and then there's eventually this huge cascading event, which is really the important event that occurs in the entire kind of domino cycle of the market occurring. We got to come up with a cool name of it. I'll show it one of these days. In terms of exactly how it happens, but it's that we'll call it the resonance cascade if you're a Half-Life fan, right? It's that moment where everything starts to fall, and then unemployment spikes up, and it's because the demand from the worker sector has started to fall off, cutting into the profits of the corporations, of the companies. And then the cascading event happens where companies have to lay people off. And then that only decreases demand, which leads to more layoffs, and then asset prices fall, which collapses the financial economy. So that's, that's the event that occurs. And so I think that is the backdoor way in which higher interest rates could cause the market to roll over, and that is really just because it attacks the bottom 50%, and the higher interest rates do, which again just adds to just the horrible nature of it, right? Is that if higher interest rates do actually slow the economy down, they do it on the backs of the most susceptible in the economy to the damage that's going to be done. I'm far from a bleeding heart liberal here, but I'll tell you, it is terrible. It's just absolutely terrible. I will say we likely made quite the leap when we went into kind of the neoclassical mindset from the pre-neoclassical mindset economic regime prior to, say, 1913 or the Great Financial Crisis or the Great Depression. But we need to get out of it fast. We've stayed there long enough. So yeah, I hope that helps in terms of my thinking of how higher interest rates could get and eventually kind of find their way into slowing the economy down enough to kind of crash things. Give me 1 second here to read the next questions. I apologize. I have so many things going on. I have 4 screens in front of me, and I still don't have enough. I still have enough screen space to have everything up. Let's see. Next question by Bington. Okay, yeah, I will hit. Yeah, Monique, I have it written down. I even opened up a tab that we'll look at in a second. Do you pay any attention to the senior loan officer survey? I've never checked that out. If you want to, when this video is done too, if you want to drop a line in the comment section with a link or something like that, I can definitely check it out if there's something on there that you think is kind of worth taking a look at. Next up, okay. So there are 2 components to that tweet. The first one being what interest rates do, and then the second one being, let's pull that up here, what the distribution of wealth looks like. And it's worth pointing out, and I got this data from, and I linked, if you want this, in the tweet thread too, if you want this data right here. It's pretty cool. I'd never seen it before a couple weeks ago. Distribution of household wealth on the Fed website. You can play around with it and see, how wealth distribution looks going all the way back to the 1990s. But what was really interesting to me is heading into Q3, Q4, heading into that post-Great Financial Crisis, there was a slow build of the bottom 50% getting slightly higher and higher, but then heading into Q4 of 2019, so still pre-COVID, into Q2 of 2022, you saw the bottom 50% nearly double in terms of its overall wealth, or share of total wealth. And the point I was simply trying to make is, at the very least, it seems as though we have some evidence, and this needs to be thoroughly thought through and kind of pushed through academic rigor, but it seems as though direct stimulus checks accomplished the goal that they needed to, right? Not only did they stop asset prices collapsing the bank sector, right, during the sell-off in March of 2020, but they gave a cushion to the most vulnerable in society, right? And it worked. Was it applied the best? Was it as well thought out as it needed to be? No, but given the fact that shit had literally hit the fan and no one had ever planned for this from a fiscal and monetary side of things, I think all things considered, I'll give policymakers a credit, that both Trump and Biden, for at least getting on it and realizing that in that moment austerity was not the best call. So not only did it save what would have inevitably been a pretty nasty collapse, where you were not only going to get inflation just due to supply chain issues, But you were also going to get a deflationary collapse of the economy. And then the other benefit is that it just increased the wealth of the bottom 50%, which obviously the general trend for the last 100 years or whatever has been an increase of the wealth of the top 1%. Really the ones who ended up eating it seems the most. And obviously there's no way to tell if this is perfect correlation. Turned out to be the 90 to 99% of wealth owners seem to be the ones who benefited the least from that. But I mean, obviously, if that's you, that was you're probably doing okay, and probably like me, happy to see that at the very least, the bottom 50% were able to benefit. One of the questions that came up, there's actually a good question, is don't the wealthy own all the assets, and didn't the assets spike through the roof during COVID, stocks and everything? And the answer was yes. Obviously, they did, but nevertheless, as a whole, the bottom 50% now have a higher share of wealth. So, based on the data, based on MMT theory, higher interest rates gives income to money owners to begin with, right? And obviously, the largest money owners are going to be those in the top percentile, and they also push prices higher for those who have the least amount of money. And so it's just it's a bad situation all around, whereas what seems to be direct stimulus payments seem to do the exact opposite. So as a whole, all things being considered, I think if we're going to run stimulus, because higher interest rates are stimulus. I need to point that out. Higher rates are stimulus. If we're going to run stimulus, we need to do it from the bottom up. I just think the impact is best from the bottom up. Let's see. That was tweet number 2. So let's do this. I think we're an hour in. Wait, are we 2 hours in? Did I start? What time did I start? I started at 6:30. We're an hour and a half in. Holy cow. Time flies when, no, we've been live for an hour. Never mind. Did I start I don't even know what time I started now. I think I started, let me see what time I said I started at. 7 o'clock. Yeah, okay. We're an hour in. I think I can go for another 30 minutes or so. So let's do this. Gessel. Steve Keen has talked about this in quite a few of his lectures when he speaks on endogenous money. There was a lecture series 15, 16, 17. It was not a grad lecture. It was not a master's lecture. So must have been an undergrad lecture 6, I think it was, about halfway in between. He gives the story. Maybe I'm wrong. But during the hyperinflation, was it before the hyperinflation? There was a town in, I'm going to get everything wrong here, Austria, I believe, that this is also to answer the question about inflation actually being good for an economy, right? Like how you can get that. And I think it will make intuitive sense when we get there. It did to me. I mean, the first time I heard it, I was like, oh, wow, yeah, that actually kind of makes sense. How does this work? So the idea this Gessel guy came up with is to essentially put an end date on a currency, right? And that if you were gonna spend, when you had currency, and I think it only worked in this specific town that this was set up in, and I don't know if he ended up setting up, if it was just his theory, but the idea is you have money and it has a timestamp on it where it will become worthless. So if you don't use the money, and whatever, I forget what the timestamp was, but if you don't use the money by the coupon date, then it's going to become worthless. And the idea is to depreciate the money to essentially kind of play hot potato, to run the economy as absolutely hot as possible, right? And what's happening here is it's only the money that's depreciating. So it's important, and this is, I was having a discussion with a friend the other night about this exact topic, and it really clicked when the prices will stay the same in the economy, right? So, I mean, if an iPad is $300, then the iPad's always going to stay $300. It's just the currency that's going to depreciate, right? If you don't use it, you're going to end up losing it. And what that ends up doing is it ends up promoting output. It ends up promoting the individual agents in the economy to go look for jobs, right? And a way to think about it is, right, we all have things that if it could be done, right, we'd be willing to pay for it. But we all have this need to save, right? And we all need to save for essentially a rainy day, right? So there's this savings need that ends up kind of chewing away at how's the best way to put this? I don't want to say output, but it ends up chewing away at what would otherwise be demand, right? So in other words, I think another way to look at it is if you knew that you would have the necessary income throughout the year to kind of pay for all your expenses that are going to come up, like in theory, you wouldn't have a need for savings, right? Now I realize that's not a realistic expectation, just given the way the world works, right? I mean, if you're what's up, Bijou? Thanks for joining. I'm explaining the Gessel dollar right now and the idea, and I'm going to do a terrible job at it. So by all means, correct me when I'm wrong here and make sure you elucidate the points that I'm missing here. But so we all need to save. And a good way to think about it is just go down to like, the absolute beginning story of savings, right? The reason you would save, let's say you're a farmer, right? The reason you would save, one, because your income's only going to come once a year when you finally till the land and sell whatever it is you've been farming, or however often you can do the cycle. And so you need to save because you don't know what your expenses are going to be in the future, and you also don't know how profitable not only the sale this year is going to be, but the sale next year is going to be. So it makes sense to save. But the problem then in savings is that savings could be someone else's income, right? I mean, if you didn't have to save, when you spend that becomes someone else's income. And if there's someone who's willing to, mow your lawn, or there's someone who's willing to, do whatever, that can become their income. And also, if it can also become another kind of production unit for the business sector, right? I mean, you can buy another iPad, right? If you didn't have to save or whatever. I mean, you get the idea. So savings is a demand leakage in the global economy. And the idea that Gessel came up with is if specifically you can target the currency, right? So we would call this inflation. If the currency itself was depreciating, then you'd have to spend it. And the outcome of and I think this only ran for not too much time, 6 months, a year, or whatever. The outcome of this little experiment in the Austrian town was zero unemployment and just massive productivity and output, because everyone, it was hot potato. You had to spend the currency, and if you're going to spend if there's going to be this unlimited demand because this currency is going to evaporate, you're going to get a lot of people lining up to do things to get that currency, and so it's really going to get the wheels churning for the economy. And then there's even just kind of the philosophical knock-on effect of all of this idea too. And this is why, again, people are going to just absolutely the Austrians and the monetarists and my critics are just going to absolutely puke in the comment section. By all means, bring it on. And I'm saying inflation is actually a good thing if done correctly. But this is why I think inflation makes sense. Currency inflation makes sense. I mean, really, the last thing you want to do, this is why Bitcoin, beyond every other problem with Bitcoin, you don't want a deflationary currency. I mean, you want people who are not hoarding your currency. You want the economy to be, at the very least, investing in the currency, right? I don't know why you would want. It's a good point about the output being bullshit. Yeah, you don't want a currency that is not forcing. Yeah, this is actually a good point. A good time to tie in the bullshit jobs. That's not forcing productivity and innovation, right? I mean, that's why you have an economy in the first place. It's to have innovation, and to get new toys, to get things done, to get the most out of life, right? That's what that's kind of what the point of all this is. So you get something like Bitcoin, you get a gold-backed currency. you're only going to encourage people to save in that in the hope that it's going to appreciate. And I mean, great if you can make some money on capital appreciation, but you're doing that at the expense of real output, and so that's why, I mean, inflation, insofar as it comes from the currency depreciation side, is actually, I mean, I think it's actually a good thing to allow the economy to run hot for a while, to allow innovation to occur, to allow constant investment, and really just get everyone kind of working, and just kind of producing the human output that we're all here for, to be done. I mean, I'm almost happy that although I don't think people have drawn the right conclusions out of this, I'm almost happy that the whole Bitcoin thing played out, because we've seen in real time what a terrible idea it is to have some sort of quote unquote deflationary asset be the center of a money system. I mean, it is just, there is nothing good that ever came out of the Bitcoin, the quote unquote Bitcoin economy, Bitcoin finance. It was just Ponzi schemes on top of Ponzi schemes. Even if Bitcoin went up, there was no production, there was no real output that ever came out of that entire endeavor. And if you want to say that the shared ledger was like the big innovation, I think the Italians figured that out 500-600 years ago. I mean, I don't think that we all need a copy of the same ledger to get it right. I think the accounting principles that have been at play by just a centralized ledger system is fine. Have we certainly got things very wrong from a policy perspective? Yes, but accounting's been a pretty darn effective tool for quite a while. All right. I'm going to digress. That is why I think inflation, currency devaluation can be a good thing. And when I say currency devaluation, I'm not talking about countries that don't have real resources to export, that are collapsing, that find themselves in situations like Venezuela, and situations like Argentina, et cetera, go down the list, just printing out money. That's not what I'm talking about. I mean, I'm talking about the money depreciating to force the output. So hopefully that makes the I'm getting tongue tied. Distinguishing between the two makes sense here. All right, let's go through some chat here. And much easier to stabilize a low rate of inflation. Hoarding causes instability and speculation. Yes, but everyone knows stamp depreciation is completely stable. Currency is for circulation, not hoarding. Long-term contracts stabilize prices. Yeah. Let's see. Also, I think if you ask most people if they would prefer price hikes to hidden, or price increases to be hidden, they would rather have hidden price drops for wages. It sucks, but just one price. Deflation means price hikes are hidden. Would a depreciating currency such as that be a means to stimulate spending among aging population? A young currency for an old people. Oh, I think is what you're saying. Kind of getting, as people retire, get them to actually spend their money as opposed to kind of save it for their children. Is that kind of what you're getting at, Kentucky? Because just kind of thinking through, yeah. I mean, yeah, I think it would be part of the process there, right? Getting the savings out of. Yeah, and spent, and becoming real, to allow real output. Allow real output to happen. Yeah, I think that makes a lot of sense. Is kind of one of the reasons why that would, kind of one of the implications of that. Let's see. Yeah, I have this idea. Again, going along those lines. Well, I'll save it for another day. I'll hold it off for now. But yeah. I mean, obviously, large hoards of wealth do absolutely nothing. And I mean, I get the desire to have the next generation inherit your wealth, and certainly I want to leave my what I've worked for my kids, and I hope my parents do the same for me. Yeah, joking aside, but obviously, I mean, we all benefit. Yeah, we all, yeah, Bob Knight. Yeah, but people are getting older and older, man. My parents are looking like they're going to live forever. um, Let me think. Yeah, I'm sorry. Being a little crass. Hopefully you guys know I'm joking there. But yeah, obviously if that money gets spent into the real economy, I mean, that benefits everybody, right? I mean, yeah, there's, yeah, 93. My parents are not quite there yet to that age, but certainly time is flying by. What was I gonna say? But yeah. I mean, getting that savings into the real economy would obviously be a benefit to the real economy. Yeah. I mean, it would be a net benefit for output. Let's see. We're going to be heading into an hour and a half here. I'm definitely happy to save and chat for a little longer as questions come on in. Yeah, Ken, it's better to just accommodate savings desire via fiscal policy rather than coming up with schemes to force people to spend. It's not like money is a finite resource. I think I lean that way pragmatically, and I think that's probably what you mean is kind of pragmatically. It's easier and far more palatable over the next decade or two to come up with policies that just inject currency into the bottom 50% to get the economy running hotter. I mean, you're probably right. Yeah. Yeah, glad to do it, Kentucky. And again, the goal, as I was discussing this earlier, the goal is to make Tuesday night the thing. Yeah, printing money is a no-no for some people. Printing money. Speaking of printing money, I do wonder why. Yeah. I'm just thinking now out loud about QE being considered printing money for all those years, and then we finally actually print money. What the QE is printing money people think when we actually print money, I don't know. Anyway, I do. The game plan is to get on a schedule with these live streams. I just got to find the best date to get them to work and kind of settle in on that date. There's both my own kind of life week by week cycle that plays through, and then finding just a good time to get good traction where as many people as possible who can make it. Bijou, yeah, that's the other way to do it. I think the experiment you're referencing, is that the experiment that played out in Austria, Bijou? Because I mean, getting people to understand right now some just basic accounting seems almost insurmountable at this point, right? Right, just getting people to realize that the national debt is private sector saving is private sector saving. I mean, that's a difficult enough task. Speaking of which, that's kind of the next hopefully viral tweet that I'm working on. I've got some graphics that I'm going to show that hopefully demonstrate in kind of fun, edgy manner that kind of triggers people on Twitter. That is how things play out. So, let's see. Yeah, Bob Knight, it's not printing money. When spending is on higher labor and contract, it's compensation. Yeah. I mean, that's a really good point about the compensation. Bijou and I were having this discussion the other night. That particularly the discussion was on UBI. God, this is going to open up another can of worms. behind UBI versus a job guarantee. And I think my thinking was off on this because I was always on a UBI standpoint. And in part, the reason that UBI kind of resonated with me was because I can see a future where production of goods and services is so dominated by AI and automation that it's just going to be so difficult to have people employed anyway. So to go the UBI route, but I think the good counter argument to that sort of UBI argument is to say, because usually they'll say, well, UBI will free people up to do things that they want to do. Well, if there's anything you want to do, by definition, that is real output, right? So why not make it a job, right? I mean, why not encourage that output to happen as opposed to just pure, kind of pure, I don't want to call it laziness, but just pure kind of self-indulgence, we'll call it. And so, and then the other thing too is, at just an absolute base theory case, right? Money is a claim on someone else's assets. So if you're going to hand out money for no output in any way, there does seem to be a bit of a social order breakdown there. And so I think you could easily make the kind of ethical case that just, we'll call it just free money, UBI style, would almost justifiably create class tension. So our argument would be a job guarantee could be as simple as saying, hey, I have this idea for some, I've noticed my chair has been sliding down throughout the night. You could make the case that if there's anything to be done, if you have art to make, that sort of thing, whatever it is, that you could still make that a government job, right? Where the government pays you, and then that just becomes the net saving desire that you need to fulfill, and then you've at least created some output for the economy, and therefore, therefore then the money that you do have is kind of a justifiable right claim on someone else's assets. So that is kind of the implication from the UBI stuff and the job guarantee, and then kind of what you might call the social or ethical implications of what money is, and relative to kind of the job guarantee. So it clicked for me. Reciprocity is a good way of putting it. Yeah. Let me pull back up the chat window here. Let's see. Teddy Brewski, welcome. Thanks for dropping a line. The problem is people have fundamental misunderstanding of what money actually is. They think money is not government money, that it is taxpayer or private sector money. But this is a contradiction. Yes. That's a tough one, and it's kind of like, I mean, it's almost like a deep-seated religious belief, right? I mean, you're stealing my money, taxes steal money, and so I get that. And it's hard. I mean, the minute you talk about spending money, it triggers that kind of emotional response. I have always found for the few people that have been persuadable, that just if they understand the basics of accounting, to just pull out your pen, pull out your paper, and just do the basic balance sheet operations, and use just a simple example of mowing the lawn or buying your home or something like that to show banks operating, how that works, and to show how the fiscal situation operates as well. The few people that it's really clicked with, it usually happens when you just spell it out. And actually, I mean, really the best way to kind of start off the discussion is just saying, well, where does the tax dollar come from? And if they're astute enough, the wrong answer that they will come up with is, well, the banks just create the loans. But if they've got to that point, then at the very least you can start the discussion using full monetary operations. Do you believe the Fed controls all bond yields or just the short-term yield? I mean, I would say the entire, Adam, good question. I would say the entire yield curve is a projection of what traders think the Fed is going to be doing
at that point in time. I mean, that's how I would say what the yield curve is. So obviously it's an open market, and the market can do whatever it wants to do. But at any given time, obviously the Fed could just stop issuing bonds across the entire year, across the entire yield curve, and then it all just becomes a moot point. So when you're I mean, this is where the monopoly, since they're the monopoly price setter of the ultimately of the price of money, they can just change the way the system works if they absolutely had to. So yeah, I would say, kind of as Derek just jumped in, yeah, I think the yield curve is really just the prediction of what the Fed is or what their decisions are going to be in future time. I got to read Bill Mitchell. Having people employed is a failure of imagination. There are infinite things people can do. We wake up with severe labor shortages. Yeah, I mean, that's a really good point that really resonated with me. If I hit the money, there's things I would have people do, and I guarantee there are students out there right now that would love to dig into some of the research that I would have to do. And if we had a system that was better at kind of connecting the two, it would be a net benefit, right? And the research that I could see being done would, hopefully, I think add some real value to society. And I'm sure if I'm one of 8 billion people on this planet that could obviously all think of things that could be done or could be made, et cetera, et cetera. Yes, it's reciprocity. Jobs guarantee is our claim on the state. UBI is our claim on someone else's labor. Yep. It's a great way of putting it. Looking at yields right now, the 30 and the 10 are lower than all other shorter term yields. Yeah. I mean, and it just happens because of kind of the classic yield curve inverting theory, where there's more concern about the economy. Teddy Bruschi, it's a tough one for activists, but gives us plenty of good to do. It's always a ratchet effect. Once you grok MMT, you never go back. And grok must be a Kiwi word or a typo. Let's see. Good discussion again tonight, everybody. I'm seeing the questions kind of dry up, so I think we're going to be wrapping it up soon. I do got to put a plug in one quick time before we wrap up here for the MMT Macro Trader Patreon page. Let me pull it up here. Patreon. Ask any questions too on the way out here. I mean, I'm more than happy to stay if any more questions come in. Last couple days here of the $25 offer again. Grok is an old school Greek team. Okay, I have something to look up then. I have something to Google when we're all done. Patreon.com/MMT Macro Trader. Again, this is for active traders, active investors. On December 1st, it actually will probably end up being, I'll let you in on something. I'll probably be busy on December 1st. So I'm going to say at the end of November. But likely it won't be until Friday or Saturday. So if this is something you want, get on it as soon as possible. But $25 for all the updates. You'll have the top tier access going forward. But when November ends, I'm going to break things out into two tiers. The top tier for like active kind of day trader type that gets access to everything, and then a weekly tier that just is kind of a dump of the major data. And then eventually I'll build maybe just like a support tier where maybe I just kind of nicely display all the fiscal data and everything for those who just kind of want to track or play around with it. Something like that. I could easily do maybe on a monthly basis if you just want to support. But for now, I mean, these higher tiers are for active traders, active investors. If I ever monetize this channel and you want to thank me for a donation or something for $1 or $2, I reserve that for when I finally turn on monetization or something like that. We can do that then. But I say all that. This is really just for active traders, active investors. I think there's a lot of value here. And if you're curious about everything that's underneath the hood, I think it was the last live stream I went into a lot of detail in terms of what's going on there. So we won't go over that again. Check out the last live stream. Grok is from hacker culture, means deeply understand. Yeah, Ken, but the young ones grokking too. Once you grok, you really rock. This is over my head. Yeah, Bob Knight, glad to have you here, and thanks for engaging. This has been a ton of fun too, for myself as well. Really good discussion, and hopefully we kind of continue to grow this little corner of MMT talk, and maybe that's what will change the live stream to MMT talk. Actually, speaking of which, just as a point here, next week, in the coming weeks here, I've been really taking a lot of notes. We're working on what I will call kind of the next step in what I intend to do with this live stream, and that is start to look at Endogenous money, look at the Minsky financial instability model, start to look at a lot of that stuff as well, because I think there's a lot of good stuff to glean from that angle, and have some good discussions there. And it gets really fun when you start playing around with Minsky ideas and what Steve Keen has developed and what his software has developed. So that is on the to-do list. Let me see. Let me check my notes. Let me make sure I hit everything that I wanted to. I think I have. So if I don't see any questions in the next second or two, we're going to go ahead and wrap it up here. Yeah, what else can I say? It's been a blast tonight. Thank you, everyone, for joining. Thanks for the input. Thanks for the discussion. And make sure you give this video a thumbs up on the way out as well. And if you're somehow not subscribed, get subscribed. And if you're not following me on Twitter, follow me on Twitter. I've been a lot more active and been having a lot of fun, quite to the chagrin of my wife. Yeah, it's work, honey. It's work. Trust me, I'm doing work. So that's been a lot of fun as well. And I've got some. I don't know what grok means, but I know kids these days say banger for kind of good stuff they're making. And so my next banger tweet is already in the works. So hopefully. Yeah, if you're not on Twitter, follow me there. Anyway, I'm going to wrap things up here, and everyone have a great night, and we'll certainly talk to you next time. So until then, good trading, and we'll see you then. Bye-bye.